What is continuous fundraising? Usually, startups have funding rounds. Well, what is a round? Well, it's basically you decide the amount of money you need for a period of time hopefully, between 12 to 18 months, but it can be shorter time as well. And in order to attract new funds, you need to define the terms for the funding round, the valuation, and put all the documents in place and make sure that everything is ready for investors to come in. Obviously, you need to have your pitch deck and these things in order as well. But what is the issue? Well, who is the first investor? How do you get someone to commit? Usually it's easier to get the funding round closed when you have already a lead investor. Lead investor is someone who is usually, as the name and term tells, taking the lead in the negotiations and doing that on behalf of the other investors. And if you have more than one investor involved, then it's called a syndicate. And oftentimes you need more than one person or investor to get the funding objective achieved. So how do you do that? It's a bit of a chicken and egg problem, because everybody is looking and waiting for someone else to make the first move. And this is obviously a bit troubling. And as a startup, as an entrepreneur, as a founder, you don't have too much time to wait. And obviously fundraising is not fun. It's taking your attention from the other things, namely building your company, but it's something you need to do. And fundraising is like sales. You pretty much need to do it all the time. So how to solve this issue? How to get your funding objectives achieved and be successful in a way that it doesn't drain you? Well, something which I've been recommending to do, obviously this may not may be in your case the optimal choice, but in some cases and oftentimes I recommend is to shift to a model called continuous fundraising. What does it mean? Well, in the traditional fundraising, you define the round. Let's say you want to get 1 million, and then you basically knock on doors, send your pitch decks, get a lot of rejection, and finally, when you have enough investors and you agree on the terms, then you close the round. But this can take anywhere between a few weeks, which is exceptional, to usual, to 6 to 8 months, even in longer times, 9 months, 12 months to close from the initial start. And the money only comes when the documents are signed and it is actually in the bank account. And in order to prevent this to happen, continuous fundraising is a process where you put everything ready for the investors. You maybe standardize your documents, your investment agreement, your shareholder agreement. You define the terms for the round. You get approval from shareholders as well, from the owners of the company and the previous investors, if you have those, so that you actually have the capabilities of closing a round. But what you do is that you can set a total amount, what you want to get. You can call it a round if you like, and you put a valuation in place and the basic terms. But instead of waiting for everyone to come on board and finally close it at once with huge delay often, you can do it in a way where first come, first served. And it means that you take the money as it comes. You don't wait. Well, how to achieve this one? Well, you could, for example, say that, let's keep on the example of 1 million, that you want to get the first 200,000 quickly. And you would say that, okay, I'm willing to give a 20% discount on the one who is giving the first 200,000 or for the first 200,000. And then you can, for example, say that, okay, the next 100,000 you're giving a 10%, or the next 200,000 you're giving a 10% discount on the valuation, whatever that is in your case. So you're actually giving an incentive for the investor to come first. And as you say, you take the money when it comes and you keep on going. Well, obviously you can achieve this with the convertible notes, and it's been done a lot with convertible notes. That's a bit off the topic here, but you could also do it with equity investing as well. Basically, you can approve with your board, depending on your local legislation, but usually it's possible to approve these rounds, if you call them mini rounds, even per investor basis, if you will. So in this way, you can get the funding started, and there are only obviously a few covenants as well. One of them is that it's not credible if you say that you give a discount and then you actually are not raising the valuation or keeping the valuation and reducing the discount, if you will. But you basically, what you need to do is you have to keep your word and show that, if you wait around, there's no point waiting because the price is going up. And when you get the ball moving, you get the fundraising round going, this gives you also a bit more leverage. One of the things is that if you take investors like piecemeal type, they don't have that much leverage, because usually what happens as well is that when all the investors are starting to negotiate the deal, they have the leverage, the time is on their side. And you, in some cases, you even may have revealed the other parties, so they can even collude against you, if you will. So if you take the money when it comes, and when you actually don't need it, that's even better case. This way, more or less, you can set the terms. If you standardize the documents, and if you say this is how I'm going to do, obviously this is a bit more advanced technique to go through. If you first time founder, take someone who already has done rounds before to help you with this thing, because obviously if you put your valuation too high, or your shareholder agreement, your investment agreement are not exactly on the money, you are not closing any investors, and you're just wasting your time as well. So this is something which I nowadays recommend for a lot of people to do. Continuous fundraising. Obviously this was just a quick overview and idea for you to ponder and think about a bit. But if you have any other ideas how to also break the first move block, which often happens, I'm happy to hear, and feel free to leave your comments, and see you in the next video.